Welcome to Dividend Talk, episode 162, an interview with Brad Thomas, aka Mr. REIT. Guys, this is a special episode because we have Brad Thomas on, Mr. REIT. In this episode, he will discuss a little bit with us about why he likes investing in real estate investment trusts, a little bit more about his experiences. He educates us also a little bit on how you should evaluate a real estate investment trust. He also lets us know why he's bullish on real estate investment trust in general, and he provides us today with several stock tickers of real estate investment trusts that he thinks are at least fairly valued today, or even better, some even undervalued. So guys, get your coffee ready, enjoy this podcast, and see you on the inside.
Hey, European DJ. How are you, my friend?
Really good. I had a tough week at home, spending the whole week with my kids, but next week I will get back to work again. And yeah, of course, really excited for today because we had a long range of guests in the past, and today we are having Brad Thomas with us. And maybe Brad, maybe for the people that have never heard of you yet, which I think is not really the case, but just in case, could you introduce yourself a bit to us?
Great, thank you, and it's great to see you both. So yeah, I'm Brad Thomas. I'm a financial writer and analyst, and I'm the CEO of a company called Wide Moat Research, and I've been in the real estate industry for about 3 decades. So before I became a stock writer, I was a real estate developer, and so I built primarily shopping centers and a lot of freestanding properties, and got exposed to a lot of different real estate sectors, and then started writing in about 2010 on Seeking Alpha. And over the last 13 years, I've been able to build a pretty large following, about 110,000 followers, and which is the largest on Seeking Alpha. And we also have other products. I'm the editor of Forbes Real Estate. We have a newsletter with Forbes. And again, I'm the CEO of Wide Moat Research. We have a very large business there, over 175,000 customers around the world. Which I'm sure include many in Europe, and we have 2 analysts in Europe as well. So it's always great to connect with you all from the other side of the water.
Yeah, it's awesome. We have a large listener base here from the US as well, so it's always great to get both perspectives. I think we can learn quite a bit looking at each other's styles and differences. But we're really excited to have you here. You're known as Mr. REIT for a reason, so we can't wait to dig in and get some of that knowledge out of you. But before we get into that, we usually start our shows with a little bit of the news of the week. And I think given the theme of the show, we put out lots of different questions, or we asked our listeners to provide questions, and one that has popped up quite a bit actually is that Realty Income announces a 950 million investment in Bellagio. I'm not surprised this has come up, but what was your initial reaction to that news?
Well, actually, I guess forecasted that we knew Bellagio was going to monetize at least an interest with Blackstone, and a lot of people felt like Vici was probably one of the likely bidders for the property. Of course, we cover Vici as well. Happy to talk about Vici, which is the largest gaming REIT, but Realty Income has already, of course, purchased another casino in Boston called the Encore Boston. It's a Wynn property, and so that was about $1.8 billion. That closed in December of 2022, and so it seemed very likely that Realty Income was going to add more casinos to its portfolio, which of course it has. Now, the way this Bellagio deal was structured was a little bit unique. So to break it down, you're right, it was 950 million. About 350 million or so of that was actually invested in the equity of the real estate. And I forget the percentages, but Realty Income got a percentage of equity in the real estate. They also invested about 600 million in preferred and paid off some preferreds. The important thing is the blended return was about 7.7%. So it was definitely, accretive or attractive to Realty Income investors. What really was interesting with this deal and what made it attractive was the fact that there was existing debt that was on the property that Realty Income was able to step in and basically assume. And so there was no new debt that had to be issued, which of course that would be extremely higher interest today. If new debt were issued for Realty Income, you're probably talking about somewhere a sub 6, maybe a 5.7, 5.8% interest rate. So they were able to utilize existing debt, which was about 3.75%, which again, that generated a very attractive return for Realty Income. And again, I'm anxious to see Realty Income get into some more of these deals. I believe that the casino sector in general, and I'm talking about in the U.S. as well as Europe, by the way. I think the casino sector is very aligned for a sell-leaseback. So a lot of these companies like Bellagio, MGM, of course, sold the properties to become a REIT, and eventually Vici bought that company, which was MGM Growth Properties. But a number of these casinos really don't need to own the real estate. And so it makes sense. These REITs are really in a perfect position to help these casinos monetize their assets utilizing the sell-leaseback structure. So that's something we're really focused on. I think you're going to see more companies execute sell-leaseback transactions in this environment. Again, with these rising rates, if you look, there is about $12 trillion of net lease properties around the world that companies like Vici or Realty Income or Agree, WP Carey, that they can purchase. And what's really interesting is there's $1.2 trillion of debt with S&P 500 companies that will be maturing over the next 3 years. And when that debt reprices, it's going to make it extremely more attractive for companies like Realty Income to step in and say, buy some assets from Target or from Home Depot or some of these large companies, because it's a lot more efficient for them to sell the real estate, lease it back to a landlord like Realty Income, because you lock in these long-term basically cap rates over long periods of time. So the return for these companies are really more attractive right now in this particular environment. So we think there'll be a tremendous demand in the net lease sector, and which is now the third largest sector of equity REITs in the U.S. And we think that will continue to grow, and you'll at some point have the net lease REITs being the most dominant sector within the equity REIT universe.
Yeah, so a couple of questions from that, and actually it's from some of our community as well. Anders and Kevin, they kind of asked, do you think obviously I think you kind of do, but do you think it is a smart move for Realty Income to move into these kind of properties? Or do you see it as a move that's kind of stepping on Vici's toes, so to speak?
Yeah, no, I think it's a good move for Realty Income. I mean, scale has its advantages, and these are bigger deals. I mean, this was like a billion. I mean, if you look at the last two deals, one was 1.8 billion. Now we've got just under $1 billion. So you think about it, I mean, it would take a lot of advanced auto parts stores or a lot of tractor supply stores to do the same volume. So they can go and do one big transaction, and so that's one. It's a lot easier for them. Plus, they own these trophy assets. I mean, I think the casino sector is proven. Even during the pandemic, we saw with Vici 100% rent collection, which is unheard of. 100% rent collection during the pandemic, and also during recessions, the gaming sector has actually performed pretty well, at least in the U.S. And so, I think Realty Income has done an excellent job. I know the CEO, the management team really well. We interview all of these CEOs very frequently to kind of get their insight. And I can tell you, in terms of the acquisitions, screening for these properties, Realty Income does an excellent job with the coverage ratios. Again, these are trophy properties. I ask people a lot. I mean, I'm sure you've all been to Las Vegas, and I can't really envision or imagine a MGM Dart closing down. It's just hard to even, because you think about it, the worst kind of black swan is the pandemic, which of course, MGM was technically shut down. There was nobody, operating in the casinos for a period of time, but they still collected rent. So they've gone through recessions, pandemics, and also just the Las Vegas market in general is doing extremely well. And there's a lot of growth there. So you definitely look for Realty Income to expand that business. And conversely, Vici has expanded outside of gaming. They're not just a gaming REIT anymore, gaming landlord. They are expanding in other experiential sectors. They're in amusement parks now, and some golf operations, and now wellness, health and wellness. So I definitely look for Vici to start expanding here. So the game is really about consolidation. It's a very fragmented market. I mentioned $12 trillion. So what you're going to see is the bigger get bigger. I definitely believe, and I've written about this quite a bit, so this is nothing new, but I think companies like Spirit Realty, which I'm a shareholder in as well, I think they potentially are a takeover target. I think a company like Realty Income should be pursuing Spirit at some price. And so I do think there's some opportunity for consolidation within the REIT sector. There's around, 17 REITs now in our overall coverage spectrum. So we think there'll be a bit of consolidation within the net lease REIT sector, and there'll be maybe, a couple really big names. And Realty Income, Vici, Agree will probably be in that list. WP Carey will probably be in that list, although they've struggled quite a bit with their office exposure. But of course, they've got a very impressive industrial business as well. So I think you're going to see more of that. And by the way, it's not just in the net lease sector. I think retail in general, shopping centers, for example, we saw an announcement this week. In fact, Monday morning announcement that Kimco, ticker KIM, is acquiring RPT, which is about a $2 billion transaction. So I think you'll see more retail consolidation, whether or not, Kimco goes after, for example, Retail Opportunity Investment Corp, ROIC. We think that would be a pretty healthy combination M&A deal for Kimco. So I think you're going to still see some more consolidation, especially right now with the pricing discounts that you're seeing in the REIT space.
So Brett, maybe because I also own some Realty Income, right? And when I was looking into it, and this is what I want to ask you before we move to the other topics for today, I often have the feeling like this company is becoming so big that it's hard for them to grow. And you mentioned already they need to do really big deals now. I also saw them going into Europe, and being in Europe, it feels a bit for me like diversification in the seek for growth. So what's your opinion on that for such a large company already as Realty Income? I know you mentioned just about the opportunity of the entire market, but it sounds like it really needs to come then a lot from acquisitions or really, really big deals. And the question is, how many are there and how attractive are they for a company like Realty Income?
Yeah, that's a great point. And again, I mentioned that number, 1.22 trillion. So when you look at just in the US, for example, the S&P companies that have debt that's maturing, I think, Realty Income's in a perfect position to utilize their scale advantage. And, I look at this sector a lot like, I'm sure I'm older than you all, but back in the the 80s, when the banks were starting to consolidate, and you had a lot of these super regional banks that were consolidating, companies that Bank of America and Wells Fargo were buying a lot of these regional banks. There were just way too many banks. And so I look at the net lease sector a lot like I did in the banking world in the 80s. So I think you're going to see more of that consolidation because, again, it doesn't take a lot of cost to run a net lease REIT. You're not there's not a lot of labor involved. There's not a whole lot of management involved in these properties like hotels or apartments. Yeah. So I definitely believe companies like Realty Income have infrastructure in place. And the margins are really good for them. So again, those two advantages, the scale advantage is really what's out there. Now they are going to have to grow more, obviously, because they've got a much bigger denominator to grow. But again, they've been successful. They just raised their guidance from 6 billion to 7 billion. I think they'll probably blow past that as well, especially if we look at an acquisition like a Spirit or another big company that they acquire. So I definitely think, Realty Income is a very attractive now, obviously from a valuation perspective. The company's trading at a really, not an all-time low, but they're certainly trading at a pretty massive discount. And of course, any company that's going to, brand the company as the monthly dividend company, the last thing they're going to do is cut the dividend.
Yes, of course.
Pretty safe.
Yeah.
Awesome. I mean, we're still on the news of the week, so I'm still quite excited to get into more questions, and I'm most certain that we'll talk about this later on. But we'll kind of just move on just a little bit. And I did want to touch on one thing. I do follow you on Seeking Alpha, and I do know that you have a book coming up, and I think it's a pretty big deal. If you just maybe want to give some information around that, because I think it's a pretty awesome achievement.
Yeah, I had I think I put it in the other room, but actually I don't have the book yet. I'll have the book in about 2 weeks, I hope. But I actually have the cover, but I do have the REIT for Dummies. So this is my first Dummies book. Everybody's familiar with the Dummies cover, the yellow cover. And I'm excited. I mean, this will be my 4th book that I've written. And, this one's really special because I really felt like I could, I love writing. I mean, now, I've been doing this, and I just love writing and communicating to people. And the Dummies book is really good because it's not really more of it's not a textbook. My last 2 books have been very much more of like an academic approach, but this is really more focused to what I call average investors, average Joe or average Jane. There's a lot of entertainment, hopefully, in the book that'll make this not only, be fun to read and learn about REITs. And I've covered everything. I mean, one of the things I wanted to make sure that I did was cover everything that I could imagine, residential mortgage REITs, commercial mortgage REITs, preferreds, bonds. I mean, the whole soup to nuts. I wanted everything in here. So, it really came together nicely. And again, it's available on Amazon now. Of course, you can pre-order it. I'm also going to piggyback that with a master class called REITs for Dummies Masterclass. And we're actually putting all that together now. So you can obviously buy the book, which I encourage everybody to do, but also we're going to bundle up the book and the master class, and it'll be probably 4 or 5 different classes. You can take all those classes. And again, I really love teaching. I love writing. I do guest lectures at NYU, at Cornell, at Georgetown, Penn State, Clemson, UNC, and I'll have to get to Europe and do some over there as well. But I love teaching. I'm excited for this book because I really think this is something. And by the way, I'm going to be writing more Dummies books. So I'm doing Dividends for Dummies. That'll be my next one. And I've got some really good analysts who are helping me put all of that content together, because we cover not only REITs, we cover BDCs. I wrote an article today on BDCs, MLPs, midstream, of course, and utilities, and asset managers, home builders. So everything kind of income. Our whole shop, our whole research shop is really focused on income, and really not just income, but safe income. We really avoid all of this, chasing yield and all the sucker yields and all that. We really focus on stable and predictable income. And you both know, that is the secret to success, is just owning companies that have very predictable, sustainable dividends, and buy those companies at a margin of safety.
I can see really this this real estate investment trust for Dummies book really to take off, because we get so many questions over the years about, why does this have such a high PE ratio? And look at funds from operations. These kinds of basics, I think, are really, really what people are looking for. And once you start studying a bit about real estate investment trust, you straight away get knocked down by complicated text that's available. So I think it's really, really great that it's coming. And I was just wondering about the Dividend for Dummies book. I assume that the first page will be dedicated to why the dividend irrelevance theory is irrelevant. Because that's also a challenge that everyone gets, like, dividends are irrelevant. It's really, really hard to argue against that. But I also think most of the time people are just interested more in growth stocks, and therefore don't even want to have a proper discussion about it. But really, really, really looking forward to it, Brett.
Yeah, no, I'm excited too. And I definitely will be sending you both a copy. So make sure we get all the addresses, and I'll ship out a copy to both of you in about 2 weeks.
Awesome.
Super. Awesome.
Awesome. Okay, so we kind of have a little segment here. It's kind of a little fun round. We usually do it just to loosen up a little bit. So I'm going to ask you 5 questions. It's called our rapid fire round. You'll have 2 choices, and without thinking, you have to give us your answer. They're fun.
Okay.
There's nothing too serious here. So I will start with the first one, nice and easy. Do you prefer buying local real estate or REITs?
Oh, well, that's a great question. So, I would say, I know it's a lightning round, so I'll try to be quick. I mean, I prefer REITs because I don't have to manage the property. I don't like dealing with the 3 T's, the toilets, the trash, and the tenants, right? The 3 T's. But, you know, real estate is part of my DNA. I'm looking out this window right here, and I can see properties that I developed. I'm working on some pretty large deals right now. I've got a $100 million mixed use project we're working on right now. I've been on calls today. I love real estate. I've written about this. There are benefits to private. There's a lot of tax advantages in owning private real estate, such as, you know, utilizing 1031 exchanges or depreciation, bonus depreciation. So I love real estate, but I would say probably REITs are obviously the easiest, simplest way to go. And also I could never own a data center or a hospital or whatever, you know. So I think owning REITs, you can access so many different properties. So those pictures in the back are all buildings I built, like out back, and, you know, little shopping centers and whatever, Taco Bell. But I would say, hopefully that answers the question. I would say both, but I would say the majority of my interest right now is REITs.
Okay. Questions to get a little bit more fun here now. So soccer or football?
Oh, man. Well, my daughter's boyfriend is from Honduras, and he's a really good soccer player. So hopefully he's not listening, but I'm not a big soccer fan. When I was in Santiago a couple years ago, I was on the board of a REIT down in Chile, and I was at Starbucks, and I couldn't speak Spanish. My youngest daughter was with me. She's fluent in Spanish. She works at the Wall Street Journal right now. Lauren Thomas, you have to Google her. She's an excellent reporter at the Wall Street Journal. So she was with me in Chile, in Santiago, and I was at Starbucks, and they thought I was wearing a jacket, and they thought I was a professional soccer player. And so I posed for some pictures with some people. They thought I was like part of the team. But I like football. Football is really, you know, look, I'm here in South Carolina. We've got some terrific college football. I'm, you know, 1 hour from Clemson University, which has a great college football team. So probably college. But I will say, if you give me a third choice, it would be basketball. That jersey right there, I played basketball at a school called Presbyterian, which is a very small college, about 1,000 students. But I played basketball in college, and I love basketball. That's my favorite sport.
Okay. Third question. Christina Aguilera or Eminem?
Okay. If my wife's not watching this, I would go with Christina.
Okay. Fourth question. Would you rather to trend on Seeking Alpha or trend on Forbes?
Oh, you know, I would say, you know, well, let me see. Right now, am I trending on Seeking Alpha? Let me check I'll log in real quick. Yeah, I'm trending number 4 on Seeking Alpha right now, which is great. You know, Forbes is an interesting business model because Forbes, obviously, with Forbes, I've got to compete with, with all the other noise. It's not just, you know, so it's harder for me to get trending on Forbes because Forbes is such a bigger platform. So definitely Seeking Alpha.
Okay. And the last one, inspired by all your recent Instagram posts, Dunkin' Donuts or Starbucks?
Starbucks for sure. Dunkin' Donuts, I just don't like the coffee at Dunkin'. And I know I posted in the airport because they didn't have a Starbucks but at the airport that I was at. But Starbucks, I'm addicted. And I'm a shareholder in Starbucks too. So that's important. You know, I definitely want to put money in the companies, the stocks that I buy. But yeah, Starbucks is better. And I'm looking at one right there. I mean, I can see it. I go by there probably twice a day. Starbucks for sure.
Awesome. Yeah, look, they were just some fun questions and some good answers from you. But I think it's a good time actually to get into the main topic, and that is navigating the world of REITs. And look, the first question I have is, how did you get started in real estate and become what we now know as Mr. REIT in 2023?
Yeah. Sure. Well, when I was much younger, well, maybe not that young, but when I was younger and I was building these buildings back here with these pictures, I sold a couple of those to like Realty Income. I remember when I was probably in my 30s, I would go out to Las Vegas. There's a conference that is actually still in operation called the International Council of Shopping Centers. It's a big retail conference. It's basically like the Super Bowl for retail every May. And I would go out to meet with, different clients. And I'd go see this big booth. Realty Income had a huge booth. They still do. And I would just walk by there and I was just amazed at how big this was. And I'd go get a brochure and it's like, wow, they own a bunch of these net lease properties. So I ended up selling a couple of properties like Blockbuster and Econolube, which is a car repair shop. I sold some buildings to Realty Income. And then as my deals got bigger, I built shopping centers and I sold a couple of my shopping centers. And I bought a shopping center or two from a couple of REITs as well. So I got exposed to the REITs. They weren't as big back then. I mean, we're talking, in the 90s. And then in the 2000s is really when the REITs, sectors really started to take off. And it's all in the Dummies book. But about 2000, REITs really started to grow. A lot of new sectors came in. And then, of course, they've really grown a lot. Even coming out of the Great Recession, you had data center REITs and cell tower REITs. And now we have cannabis and farming and all kinds of other stuff. So gaming is, of course, a fairly new one. And so, that's how I got exposed to the business. And one of my good friends, he actually was the CEO of Realty Income. And his name's Tom Lewis. Tom he's retired. He's on the board of a couple other REITs right now. And Tom was an inspiration for me. He was actually the one who said, Brad, why don't you become a writer? And, he thought I was a good writer. I still don't think I'm a great writer, but he thought I was a good writer. And I took him up on that. And I started to write more articles and really build a platform to educate. And again, now we've extended that beyond REITs and covering really all the income space, which is great. And now the next chapter, of course, is going to be ETFs and launching a series of ETF strategies aimed for investors who are looking for income.
Really nice, Brett. And, I'm even interested to go even a little step, a step even back before that, because from all the jobs in the world, you could have chosen to become a doctor, a lawyer, a football player, a basketball player. So what is it that real estate attracted to you?
Well, first, I want to be a little humble here. I mean, when I played basketball, I rode the bench. I wasn't a scholarship student. I was a walk-on. So I don't think I would have made it to the NBA. If my wife would laugh at me if she said I could be a doctor, because I don't think I could have made it through med school. I loved real estate. I took real estate in college. My mother has been in real estate her entire career. And one of her first clients was Michelin Tire when Michelin came and set up their North American headquarters in the U.S. She actually sold houses for all the expatriates who were moving in from France to Greenville, South Carolina. And so I saw real estate early. My grandfather was in the motel business in Myrtle Beach, South Carolina, on the coast. And so I've always been exposed to real estate. It's in my blood. It's part of my DNA. And when I got out of college, I knew I wanted to go into real estate. I wanted to learn how to create value from the ground up. I saw a lot of the wealth. Back then, we didn't have technology where all the billionaires made their money back then. So most of the wealth we saw, if you go to the Forbes, 500 billionaire list, most of those billionaires, they still own real estate. Real estate is a great asset class for wealth creation, also for tax reasons. I mean, real estate creates a lot of good. It's a tax shield because of depreciation. So that's how I got into it, and ended up going to work with a business partner who had a lot of real estate, which exposed me to practically everything from golf courses to hotels, warehouses, shopping centers. So I really got a lot of experience, and I think that's what's really different for me from a lot of writers, because they learned maybe a lot of that in school, which I did as well. I took business and finance and statistics, corporate finance, and all this, but learning how to create value, negotiate lease contracts, contractors, architects, getting the properties leased and financed and sold. So I know how this works, literally from the ground up. So I think that's really my strategic advantage. The other thing I'll say is I've got probably the best, relationships. I know, I've got, CEOs on my phone that I can speed dial, what's going on? Why did you do this, that, they don't always call me back, but I have excellent sources. And that's really been valuable for me because, I've learned a lot in school and I've learned a lot in the trenches, but I've also learned a lot from these CEOs who are really, for the large part, not all, but for the large part, these CEOs are pretty talented. And so there's a quote that I think Ben Graham's famously said, the most durable education is self-education. And so I've been able to learn a lot about real estate and these REITs by meeting and interviewing with these CEOs or CFOs. So that's been extremely valuable for our research.
And if somebody was just coming out of college right now, is there any advice you would give them? How would they get started in this? Because to me, someone that's not in that world, it would seem quite daunting to get started.
Yeah, well, one thing is I take interns. So this summer I had 5 interns, and I'm going to keep them all. They're all continuing to work with me. They're all still in school. We'll hopefully hire some when they graduate. I would say, taking these real estate classes obviously would be really good. Attending conferences, there's a conference called NAREIT, which is the National Association for REITs here. I've gone to those conferences. Those are good to attend. Obviously, going on and reading over listening to earnings calls or reading transcripts, obviously financial statements, all of that has really been important. And again, going back to Seeking Alpha, I've learned a lot on Seeking Alpha. I learned a lot. I know a lot more now than when I started. And I've learned from a lot of people. I've got some mentors on Seeking Alpha as well. And one gentleman I want to mention named Chuck Carnevale. Chuck and I have been friends for over a decade. He owns a company called Fast Graphs, which stands for Fundamental Analysis Software Tool. It's an amazing software package. They also have international stocks, over close to 9,000 ticker symbols all over Europe, all over the country now. So, Chuck is a very good friend. He's taught me a lot about value investing. And, again, we've got a long-term experience there. So, but I would say just starting, and hopefully reading some of my articles. And the great thing is it's harder for me to get available to people because I am pretty stretched. But I have no problem, as I tell my subscribers at I Read on Alpha, I constantly do interviews with them and try to do these analyze out loud videos, give them like 5 minutes. Why would you buy or sell this company in 5 minutes or less? And I really try to help, and again, I love what I do. But I would say, surrounding yourself with those types of people would be the way to go. And obviously do a lot of reading. There's a lot of books that I could recommend. Starting with the very first book I would read, if you have it, is, of course, The Intelligent Investor, which is Ben Graham's famous book.
Awesome. And you kind of touched on this earlier on. You do go beyond REITs. Can you just tell us a little bit about your investing style now? Has it changed over the years, and how has it developed?
It has changed tremendously. When I was younger, I didn't really know what speculative means. I had to go lose money, and some serious money, not just, a few chips in Las Vegas, but millions of dollars. And I get reminded every day when I drive through my town, there's properties that I lost money on, and that's a constant reminder of not to do that again. So I love writing these lessons learned articles. Really teaching readers, hey, avoid this pitfall, avoid that mistake. So I had a lot of leverage. Banks were just throwing money at us. Again, this was before 2008, 2009. Perhaps that's what led to the Great Recession, is a lot of this lending that really did not need to occur. I was also involved in some other businesses. I owned some Papa John's pizza stores. I was a multi-unit franchisee. I was a multi-unit franchisee for Athlete's Foot. So, I made some bad bets, and it all comes back to, circle of competence now, and I can't be everything. So I want to be good at really what I'm good at. So I'm basically the REIT expert in my company. Now I've got other analysts who are really good, equally as good at BDCs, or equally as good at C corps or asset managers. So, but I've stuck with my circle of competence. I think that's really the biggest lesson that I've learned is stick to what you know, and no leverage, and again, not chase yield. I mean, I've got an article I'm going to be publishing soon, and it's another yield chasing article. I'm trying to discourage people. Don't go do sucker yields. Don't chase these high yields. It's ridiculous. And I've got so many examples of companies that I said avoid this company, and if they listen, that's great. If they didn't listen, they've lost money. So we try to really steer investors in the right direction so that they don't get into these same pitfalls.
Really, really good. And maybe talking about because this really nice bridge from the pitfalls, right? Because, and maybe it's a little bit more technical also for our listeners, but my understanding is they're a real estate investment trust. They need to pay 90% out of their profits into dividends, right? 80 or 90%. And how you say it? Can you explain a little bit in this case, like when we do our analysis, for instance, we often see that, I don't know if it's Realty Income or one of the stocks, they often pay only 60% or something like that. I'm looking here at FFO. How come that we see these kinds of differences when we hear theoretically, they need to pay out 90% of their profits? Yeah,
so I guess REITs, again, you're right. I mean, this is probably the most frequently asked question, or perhaps the biggest myth when it comes to REITs, is we don't use the traditional earnings per share metric. We use the funds from operations. Now, so funds from operation, just to break it down, that's your net income. So the property, that's basically your rental income of the property. Then you add back in the depreciation, because real estate, has depreciation. You add back in amortization and subtract out any of the gains on the sale. So that basically creates kind of this yardstick that we use, and this is a GAAP metric. So it's an approved accounting metric that we use to determine really the earnings for those companies. Now, the other thing we do is take it a step further, in which we have the adjusted funds from operations, and that's where we take FFO, we subtract out the straight line rents and the recurring CapEx and add back compensation, lease intangibles, and the deferred financing costs. And that's basically more of your realistic cash flow before the company pays the dividend. So when we look at payout ratios, the important thing is utilize the AFFO metric, but mostly beyond that, we look at FFO, because that's what the companies generally report, and those are the GAAP metrics that we use. So trying to think what your question was related to that.
According to, let's say, what we all learn is like they need to pay 90% out, right? But if I look, correct, for instance, at where is it? Okay, so, Realty Income pays 75% out of FFO. In this case.
So that's great. Okay, that's it. So the REIT law has nothing to do with FFO. So the REIT law is 90% of taxable income, not FFO, not FFO, but this is taxable income that the company generates. They have to pay at least 90%. Most of the REITs pay out closer to 100% of their taxable income. Now that's taxable income. So we add back depreciation, amortization, subtract out gains to get the FFO. So just to be a requirement under the REIT, there's a couple of requirements to be a REIT. That's one of the major ones. The company has to pay out at least 90% of their taxable income. They also, another of the big requirements is they have to own or lease 75% of their portfolio has to be real estate. And I mentioned lease because there's companies like Iron Mountain that doesn't own a lot of the real estate. They lease properties, and so you don't actually have to. Theoretically, you don't have to actually own the real estate. You can lease the property, and then lease it again. Sublease it. So, but you have to have at least 75% of the asset base has to be real estate, owned or leased, and 90% of that income, taxable income, has to be paid out in the form of dividends. The payout ratio is based on the FFO or AFFO number. So those are two different numbers.
Thanks for clarifying that, Brett, because I think this is leading to so much confusion. Also, when people look at the different numbers, right? With this in mind. Thanks.
Yeah, and I made that. Hopefully, this book. I mean, that's what I'm really excited because I think I made that very clear in there. That is one of the frequent questions that people ask, and hopefully that's clear. I know that's clear in the book as well.
Yeah. Awesome. So when you're analyzing a REIT for the first time, what do you typically look for? Is there any red flags that you look for and will immediately write that REIT off, or what exactly are you looking for?
Like red flags?
Yes.
Yeah, I would say let's start with what we just talked about. The payout ratio. I mean, that's an important one. Now we got to be careful though, because every sector is different. So in other words, let's go net lease. Net lease, there's not a whole lot of like we mentioned, CapEx and leasing commissions. Those are fairly common expenses for office buildings. And you're taking out carpet, you're paying a real estate broker to bring in a new tenant. So with net lease properties, we don't have those costs. I mean, generally those are long-term leases. So there are certainly occasions where you have to spend money on the property, but in general, these are pretty much bonds that don't require much of anything. So a net lease REIT can pay out more of their earnings, AFFO. And so I'm comfortable if a net lease REIT like Realty Income or Vici, if they pay out 82, 83, or 84, or even 85% of their AFFO, I'm okay, because there's not a whole lot more that goes in there. Now, an office REIT is a totally different situation. So if you have an office REIT that's sitting there with an 85% payout ratio, that's something to look at, because there's going to be a lot more costs that go back into those properties when they have to be released or retenanted. And so you can't just look at the whole sector and say, well, if there's a payout ratio of 85%. So we look at it from sector by sector, but payout ratio is one. The closer you get to 100, and we forecasted so many of these dividend cuts. I mean, it's great, because hopefully we've steered a lot of people away from these sucker yields. Sucker yield is simply, it's too good to be true, and so we want to get away from those. That's number one. Balance sheet, and balance sheets are really tied directly to payout ratios. Typically, a company that has a high payout ratio, they don't have very good debt. I mean, so and they're not rated, or they have a sub-investment grade rating. So a company, let's say, for example, and this is a battleground stock, I hate to even mention it, but I will, Medical Property Trust. Now, Medical Property Trust, ticker MPW, we put them on the dividend watch list back in January. And I got a lot of people mad at me. A lot of these trolls came out on Twitter and, you hate me, whatever. Okay, well, we had to do it because the payout ratio was basically right at 100%, maybe 97%. This is a sub-investment grade or junk rated, non-investment grade company, said higher leverage, payout ratio is high. Certainly, we had to take them to a dividend watch list and downgrade the company, which is exactly what we did. And of course, now when they cut the dividend, they get mad at me too, and they're like, "Oh, you wrote on the company and they cut the dividend." I said, "Well, I did write on the company, and I wrote on the company like 7 months ago, and I said they're going to cut the dividend, and they did cut the dividend." So I think the balance sheet and the payout ratio, again, they're tied really together. That high leverage. Taking that a step further, looking at the company's cost of capital. I mean, if the company's got an extremely high cost of capital, then it's not able to grow the business. I mean, they have to buy properties at this incredibly higher risky cap rate. So we look at the cost of capital. I think that's a huge indicator of future growth prospects of the company. So we look at a lot of the historic relevance of the company. How have they performed? Why did they cut the dividend in 2008? And why, anything related to the past. What are their earnings? What happened during the pandemic? So we look at the past of the company. We look at the current situation. Okay, what's the current setup? What's the guidance? What are they buying? What are they selling? And then we look at the future. And so we look at primarily analyst estimates, because there's a lot of analysts, especially here in the US, in the REIT space. We can go look at these analyst estimates and we can say, okay, well, Realty Income is projected to grow by 5% per year in 24 and 25, which is consistent with their historic dividend growth, or earnings growth. So I think we look at all the things. I mean, we try to dissect this company and really, break it apart and understand all of the fundamentals. And we rely on any information we can get, whether it's our internal research or outside external analysts that are looking at the company. And again, going back, we have terrific insight with management. So we may see something or hear something in our interviews with management that might cause us not to want to buy the company. I mean, we're not going in there as cheerleaders just to say, hey, let's do an interview. We go in there and we try to find something that's going to either help us with our buy or sell recommendation. And lots of times we learn a lot of news from these CEOs, not about their company, but they may tell us something about another company or competitor, and that could be valuable information as well. So we try to look at these companies, really in great detail. And that's why we've been successful, I think, because we're fundamental based. We're not market timers. Your channel is European Dividend Growth Investor, so we speak the same language. And it's all about, dividend growth, dividend safety, because over time, if the company's going to grow the dividend, it's going to outperform the other non-dividend payers over time, especially if you can purchase the stock or the shares at a wide margin of safety.
Thanks, Brett. And I mean, what can I say? It's you had the nail on the head there. But you triggered me as well, because we started to talk a little bit also about the cost of capital and such. And we got a question also from Simon and from Kalis, and they're really wondering, we come out of this period of cheap debt, and now the interest rates are rising, and then the Fed keeps also trying to fight inflation. And the question really is, after this decade, has the game just changed? Are we now with higher interest rates for longer? And what should we expect then from the real estate investment trust sector, the REIT sector? Is this just the new normal? Is that what we're looking at? That's kind of the question.
No, that's a great question. And, I just, to answer that, I actually wrote an article recently, and the title to that article was called "The Answer is 7." And the reason I wrote this article is back when I was in college, or right after I got out of college, I read an article called "The Answer is 9." And it was written about a Harvard professor who was teaching his class in 1971 about cap rates. And at that time, in 1971, the average cap rate was, and cap rate, again, that's your net operating income in your first year divided by the purchase price. So that's your yield. We call it yield on cost. So the yield on cost, or cap rate, was 9% on average. And today, my argument is, well, that's not my argument. The cap rates today are closer to 7% across all property sectors, net lease, self-storage, shopping centers. So cap rates have definitely adjusted to 7, but 7 is still not a bad number, because it's not as, what's more important is, what is the interest cost, and what's the difference between the 10-year treasury and cap rates today? Now, our whole argument about REITs, and this is really all centered around what we think is going to be the first quarter of 2024, is we believe could be the opportunity set. So you have between now, September 1st, and the end of the year to really start building out your portfolio, because we believe at some point what goes up is going to come down. Now, I'm not expecting rates to come down in the first quarter, perhaps in the second or third quarter or fourth. But what I am expecting is in the first quarter, rates to pause. At that point, we'll pause. The Fed's trying to get rates down to 2%. We're just over 3%. They're trying to keep getting them down to 2%. But at that point, we'll probably see another rate increase. And then I believe we'll see at some point, first quarter 24, a pause. And that pause will be the mark that the market will say, okay, we're done, and let's start moving back to normal. So your point, what is normal? That's a great question. If I knew that answer, I would probably be sitting in an island somewhere instead of my office. But here's the thing I will say. In office, you're not going to get back to normal. office will not, those valuations will not get back to normal. Whatever Boston Properties was trading at in 2016 and whatever, SL Green was trading at in 2016, I don't know what those were. I don't think we'll ever get to those valuation levels again. Office, I'm not saying is permanently, is permanently, what's the word I'm looking for? Anyway, I'll think of it in a sec. So I think the office sector is, and it really, you have to look at office too by market. I mean, in New York, I was up in New York 2 weeks ago versus say down in West Palm where I was down there Monday, South Florida. So the office markets are really completely different. You have to bifurcate, the good and the bad in the office. But I don't think the office market is ever going to get back to normal per se. Now, I can say, net lease, I think possibly net lease, again, when rates come back down, net lease is a spread investing business. So you look at your cost of capital and you look at the cap rates, and generally over time, net lease have generated profit margins of around 150 to 200 basis points. And I think they'll continue to do that over time, especially, as I mentioned, because of this wave of consolidation that I talked about earlier. And there's a lot of demand for that type of product and a lot of supply that can be consolidated. So I would say in terms of normal, again, you just have to look at each sector individually. I mean, we love data centers right now. We love cell towers. Obviously, there's been a big run up in AI, artificial intelligence, that have served as a catalyst for the data center space. So I'm glad we got in digital realty at the right time. And then we've seen that price now go up again, because that's the infrastructure. That's the backbone, critical backbone for AI is data centers. Without data centers, AI would not exist. So I think that's important. We love the tech space. Warehouses, again, they're riding on that same kind of tech trifecta. We call it tech trifecta because we have cell towers, we have data centers, and we have logistics or warehousing. They're all integrated. They all need each other. So we call that, we really like to overweight the technology space in real estate. Again, cell towers, data centers, warehouses. That's where we want to overweight the capital. Net lease, we like overweighting too, because we think that is going to be the consolidation, and those will be the big names over time. And then you've got some of those other sectors you can look at. I mean, cannabis is extremely volatile. It's sold off massively, and there's a lot of legal legislation that is kind of overriding that really stock performance. But cannabis is another space. But the great thing is there's a lot of way to play it, and it depends. Answer your question. I don't know, I answered it in a long way, but it just depends on what those sectors are. I will say, I don't think office will ever get back to normal.
Thanks, Brett. And it's interesting that you also mentioned artificial intelligence as such, because I come a bit out of the IT sector as well. And actually, I'm on digital realty trust. I really struggle with that one because over the last 4 or 5 years, let's say, when it was all about the cloud and the private cloud, I didn't see them growing. So this was one of the biggest growth eras for me, for such a real estate investment trust. So now AI pops up and I'm thinking like, okay, will it really trickle down into their funds from operations? Because they've been struggling. So for me, I really lost confidence in digital realty trust because of the lacking funds from operations they had the years before when there was a whole cloud boom and everything. So I'm wondering what makes you bullish on digital realty trust? I know the price share appreciated, but where the fundamentals also appreciate. I haven't looked at them for the last year, I must confess.
Yeah, well, you're right. I mean, I'm not as bullish today. I mean, I was, at, under $100. I mean, right. And there was a short attack. We hit that one hard because the valuation, and again, we're up to 130. So we went from 100, like 98 to 130. So it's done well. Again, fundamentals are really strong. They've got a BBB rated balance sheet, investment grade. They've really done well. They've had a bit of, management turnover, which is fine. I like the new CEO. He's younger. They brought in some kind of new, fresh blood. But if you look at the company historically, I mean, you're right. Coming out of the Great Recession, they were generating, probably on average about 8 or 9% growth overall. And over the last, you're right, 19 was negative growth, minus 2%, minus 2% in 2020. back up to 7% in 21, minus 4% in 22. But again, analyst estimates are about 5% in 24, 7% in 25. So they're really starting to move the needle again. And what they've been doing is recycling assets. That's really been the key to their growth. They're taking, and they've got so much development pipeline, and it takes a while. You have to be patient with this one because they are, in fact, a developer. They build these shell buildings, and some of them they lease out to hyperscalers. Some of them they don't, but it takes a while for them to get these buildings occupied and for that income to be generating. So that's where it comes in. That's where really our advantage of meeting with management, going and looking at these properties and evaluating the development pipeline. That's given us a lot of confidence because we knew that income was going to be catching up over time, and it has. And I think you're going to see that. And obviously the share price has reacted. Now, there's been some euphoria here with this share price, of course, with AI. Anything that's got AI associated with it, people get crazy about it. But I definitely think it's a buy. It's actually, I would say it's fairly valued right now. So I wouldn't go crazy with it. I mean, they're trading back at a 21, 22 multiple on AFFO. Again, you could have bought it, or we recommended it back at a 16 multiple. So now they're 22. So I would say wait for that one for sure.
Yeah, exactly. You're right. With these kinds of things, it's probably more like a pullback or a turnaround play. Yeah, I'm staying skeptical there. I really wonder if they also have the negotiation power with their clients and such, knowing also that they have some of the big tech companies that are also looking at cost savings and everything. So it will be really interesting on this one. Yeah.
Well, and again, once again, I think as these debt maturities, as Amazon, these big hyperscalers, I mean, they're going to need capital. So leasing is really the way to get. They don't need to be owning these assets. They can make more money efficiently leasing versus owning the real estate.
Yeah, good point.
Good. There's probably so many more questions we could ask you, but I think at this time we might move on to some of our listeners' questions because we got a couple of them, and we'd like to give them an opportunity to ask you some questions. And we'll start with Marek, who has asked you particularly, do you think that REITs can be a lifetime investment, or is it better to switch between them according to the market cycle?
Yeah, I believe, especially now, I mean, I wouldn't say that, back earlier. But now when we go back over, REITs were formed in 1960 when President Eisenhower was in office. And the first few years were rocky, and a lot of the REITs were mortgage REITs back then. Totally different business model. And then it was like I mentioned, that kind of the 80s were really the spark that went off in the 90s. REITs started to grow in size, and now they're massive, almost $2 trillion, sector. And so what I can say is REITs have now been battle tested. We've gone through multiple recessions, a pandemic. You compare REITs to some of the other income alternatives like BDCs and MLPs, they haven't been around as long. I think the real opportunity set is this. In the US, REITs own around 10% of all commercially held institutional property in the U.S. So as I drive down this street or drive back home, 1 out of 10 buildings is probably owned by a REIT. It may be the McDonald's, it might be the mall, it might be the shopping center, it might be the warehouse. But guess what? 9 out of 10 of those buildings aren't owned by REITs. So show me another business model that has so much opportunity for consolidation. And so I think that's really what I would say is a long-term play. These companies, and also consider the fact that there is an insatiable demand for income. The aging population, which we refer to as the silver tsunami, has so many people that are either in retirement or soon to be in retirement that are looking for alternative income. They don't want to own duplexes and deal with all the headaches. So REITs are perfect for that. I mean, it's perfect. So I would just say, certainly don't go all in. And this may be a question I'll go ahead and answer, but I would put somewhere between 10% of your investments up to 30%. That's a high number. Yeah. But if you're younger, you can handle it. So 10% to 30% of your investment portfolio could potentially go in REITs. I've found most investors have about 15% of their retirement in REITs. And that's a safe number, I believe, as long as you're picking, the really good companies, not chasing yield and all of that. But at any rate, that's how I definitely think this is a lifetime play, because obviously the power of compounding, you're going to see that those dividends really accumulate over time.
Alan has asked us a couple of questions, and the first one is, what are your 3 best tips when looking at mortgage REITs?
Well, I tend to stay away from residential mortgage for really a couple of reasons, but one in particular is it's not suitable for retirees to own residential mortgage REITs. Because they're leveraged, they have more debt than the other counterparts, and they're extremely more volatile because they have a lot of debt. And it's a risky game. And we've looked, and I've gone, I put together studies, and I do this about every 6 months just to tell people not to do this. You've got to be really a professional trader, a market timer, to try to make money in mortgage REITs. And I just would not suggest that to most readers. And I write about that in the book, and we cover REITs. And I'm not saying they're all bad. Preferreds are safer than the common. But in general, mortgage REITs are just dangerous, and you can do a lot better and sleep well at night without having to take that elevated risk. Now, the commercial mortgage REITs, a little different category. They're still higher risk than equity REITs. Obviously, commercial real estate, they own buildings. Plus, the commercial mortgage REITs are shorter duration, contracts. They're shorter term debt arrangements or agreements with their customers, where the mortgages are longer term. So you've got to know where to play the mortgage space. And there's a lot more liquidity in the mortgage and commercial mortgages now. Most of the private equity firms, albeit Blackstone, Starwood, TPG, KKR, Apollo, most of them all have mortgage REITs. So we like the biggest, the baddest, the safest, which would be like Blackstone and Starwood. Those are our picks in that sector.
And we know you like to write books. Do you think you'll write a book specifically on mortgage REITs?
I don't know. Here's the thing. I don't know if I would go write a book. I do think, we will be launching a high yield ETF. And I decided not to include mortgage REITs in our first ETF because I want to keep it focused to retirees and average, more average investors. But I do think there's an opportunity set for that. And I think it's a high yield product. I don't know if it'll be a book. I think it'll be an ETF. And it'll be an ETF that will include, higher yielding mortgage REITs that are safe. It'll include preferreds. It'll include bonds. It'll include midstream MOP, and it'll include BDCs. And I think when you roll all that up, you're probably talking about maybe a 10% roughly yield. And we would manage that. It'd probably be passive, but we utilize a kind of a screener that kind of gives us more of a hybrid approach. So I think that's a strategy. I really would like to launch an ETF, a high yield ETF, with just some of those safest names in there. I think that would perform well. But again, it's anytime, I don't care if it's a REIT, ETF, a stock, whatever it is, when you get to 10% yield, you're dangerous. And I think investors need to understand when you're investing in a stock that has a double-digit dividend, that is a dangerous play. And frankly, it's just, I see this time and time again. I see investors get into trouble. We try to warn them, but everybody, all of us have this insatiable demand for yield. And it's like going to Las Vegas and, you just see all the money chips sitting there. You think you can do it. And it's dangerous. So we really try to avoid putting investors into too much yield because it just doesn't work. It's not sustainable. It is absolutely not sustainable.
Good. So Brett, time goes so quick. So I think we should also start, rounding up slowly. So I really have one question that is also from Alan, one of our long loyal listeners. He's asking, if you look within the REIT sector, right, which sub-industry, let's say, would you at this moment in time over-allocate in and under-allocate in? So want to over-allocate and want to under-allocate. I think we got to raise some clues during the podcast, but
Yeah, so, I guess where I'm most bullish is I like the technology, but we've already pointed out data centers are pretty expensive right now. I still like cell towers. There's 3, of course. I like American Tower. They're they're international. If you don't know, they're not just American Tower; they're International Tower. They should change their name. But
It's the same like
AMC,
American Express, by the way, Brett. I think many people stay away from American Express credit cards here. They don't understand it. Visa, much better. MasterCard. Anyway, go ahead.
Yeah, exactly. So I'd say I like American Tower. The industrial space has gotten pretty, it's fairly valued. But I mean, Rexford is a name we like a lot. That's the pure play California. Obviously, they've been beaten up because of the California dynamics. But I like Rexford. I think Rexford is fine. I think that company is pretty cheap right now. So in the industrial, again, that they tie into that tech trifecta that I mentioned. I think owning technology right now, and you're going to see in the Dummies book, we covered prop tech. Most of these REITs have some element of prop tech. I just interviewed yesterday the CEO of Smart Rent, and I'm actually going to use Smart Rent. It may use Smart Rent in some properties. I'm buying some townhouses. I'm going to rent them out, and I may use Smart Rent technology. So there's a lot of prop tech that I think is really interesting. And another category, but a lot of REITs do have prop tech, so including industrial. So I like, Rexford Industrial. I like American Tower. And again, I have to go back to net lease because, again, I just think I'm so bullish because this is going to be like the new wave of bank financing. The banks are shut down, right? And rates are pretty elevated. And so where's a good place to access capital? It's right now with these net lease REITs. That to me is a huge catalyst that nobody on Seeking Alpha is really even talking about. They probably don't understand it. You see in the background, I built this stuff. I know a net lease pretty well. I would say net lease is going to be, if I put my, all of my kids in Realty Income and Vici and say agree, they would think I am the smartest thing in the world 10 years from now. When they look at their stock account, say, Dad, why did Dad got us these 3 net lease REITs? So I think those are kind of my bullish. Probably the bearish right now. Cannabis is just so volatile. I mean, it's not bad, but it's just too volatile. So I would say stay away from cannabis, especially for most investors. I would say the other category probably, we got out of prisons before everybody, which was a great thing. I'm glad we didn't get enamored of prisons like everybody else.
What about something like premium shopping malls, like Simon Property Group?
Yeah, I mean, look, I like. Here's the thing: it's the dominant player, right? I mean, you want to if you're going to invest in the malls, you want the dominant name. So, yes to Simon. Our mall and right. Actually, I'm going to be taking my mother to Cheesecake Factory when I get off this call, and I'll be at the mall, Simon Property, and they have the fortress balance sheet. I mean, if you're going to own malls, you want to own that one. So retail, I like retail a lot. I think, but I think some of these other. The smaller names, office, of course, that's probably where I'm probably the most bearish, especially New York City. SL Green, no thanks. Vornado, no thanks. Empire State, no thanks. I do like Highwoods. They're based in the Carolinas. They by the way, they're the only office REIT that did not cut the dividend in the Great Recession. So I like this Sun Belt focused office space. But again, I'm definitely bearish in the gateway markets, New York, San Francisco office sector. I definitely would avoid that. I like apartments. I like Mid-America. I like Sunbelt. Sunbelt. That's another ETF I'd like to build as a Sunbelt focused, ETF. I live in South Carolina, but I'm down in Florida a lot and throughout this, Sunbelt. I think those markets will do really well. And again, I guess I'm bearish on the residential mortgage. I definitely would stay away from all of that yield chasing. It's just not good. Yeah. I'm not a big fan of EPR. I'll tell you, the theater REIT, they've really had some headwinds now with the strike, the movie strike. Definitely they've already cut the dividend. 55% exposure to theaters, way too many theaters in the US. They're going to have some wood to chop. So I just would stay away from EPR. There's better opportunities in traditional net lease like Realty Income and Vici.
Nice. Well, when I heard you talking about office REITs, I had to think about my investment in Castellum, and I don't know if you know this name from your colleagues from Sweden. So
Okay.
that one we got as investors in Europe pretty much burned on, but I think here it was more like opportunistic management, specifically the CEO, who kind of, we all learned later, was a bit of a prima donna, let's call it like that.
Yeah.
Which is also, of course, often to look at, right? What kind of management is there? But maybe as a last question from the show, are there any real estate companies, I'm on purpose not saying REITs, but real estate companies that you know from Europe and that you maybe have an interest in?
Actually, Leo and Sebastian both have done some really great coverage in European names. So I'm not as familiar. I'm looking forward to doing some. He wrote on some French companies. I have a strategic relationship with a company called Alpha Value in Paris, and I go out there every year. Plan on going out again here in October, and meeting with them. But we're definitely expanding coverage in Europe. I mean, that's why I brought in 2 European analysts, and I think there's some great opportunities, and maybe potentially even a European or an international ETF as well, kind of on my radar. So I love Europe, and I definitely want to get back there soon.
Yeah. Super. Well, thank you, Brett. Thank you so much for joining us and for taking the time, effectively also to help educating our audience and share so much wealth, our knowledge with us. It's, for me, been really, really a blast.
I enjoyed it as well, and I'm here to do it again next time. So just let me know, and let's do it again.
Awesome. Well, look, as European DJ said, thanks a million. We really appreciate it. And to our listeners, we hope you got some value from this, and we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just 2 guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.